Yo guys, welcome back to Stock Talk Insider. Today I want to talk about SoFi. The biggest position, well, almost the biggest position of mine. AMD is the biggest, of course, because of all of the growth it had and because I invested more capital of my own in it, of course. But still, SoFi, it is the second biggest position in the portfolio and probably one of the most talked about on this channel. Now, I want to talk about where this stock may go, and I want to bring your guys probably the projections in your head that this stock can do in like 1 to 2 years. And I want to bring it down a little bit because I think and I know that some of you people are certain that this stock will hit $100 by now and the next 12 months. In the right terms, it can, because when the market is a lot going forward and it is actually really in a bull market, then these type of things can happen. People are very enthusiastic and all of those stuff. So in the right environment, yes, that can happen. But to stay realistic is the best way, because if you stay realistic and it still breaks through, then at the end you did stay calm. So that's the most important thing. It's not a good thing to stress every day like it has to hit this today or that day because I want to get rich. You literally need to stay consistent and just stay still and calm and invest your money, and invest more when it's down and invest less when it's high, and invest normal when it's just going normal. That's literally the fact. So I'll talk about what my price projections are by 2030, because yes, that's how long I look forward. And So SoFi has evolved from a student loan company into a complete financial ecosystem. It's a fully licensed digital bank, but also a technology platform provider. The company now operates in 3 segments: lending, financial services, technology, platform. That are the 3 segments. So this hybrid model, consumer plus infrastructure, is SoFi's hidden moat. Also, they own like everything they have, so that's also very big plus. Talking about the current financial snapshot, well, we'll look into it with macro trends. So we have the EPS, the trailing 12 months EPS. We'll get to there, like here, and EPS. The trailing 12 months EPS lies at 50 cents. Then revenue was 3.25 billion already for 2025, which is 20% year over year. And we have deposits of $20 billion, which was 40% year over year. And we have a net income margin of around 3 to 4% and a cash position of around 2 billion. Because if we look at the financials and we go to the balance sheet, we see that we actually almost have 3 billion in cash. So that's very, very steady. We went from like 1 billion to 700 million in 2021. Then we went back up to almost 2 billion. Then we had, the all-time high of 3.6. But in my opinion, they invested a lot to get even more members, because eventually you have already so much members, you have to invest more in marketing to get even more members. And that's very realistic and reasonable, of course. So to have still almost $3 billion in cash on hand is very, very important. And of course, they have some other assets, of course, because we also have the shareholder equity, which stands at 6.5 billion. So yeah, that's all very good. And just to give you guys the graph of the revenue over the year, so the trailing 12 months, it's only going up. So that's very, very strong, of course. Then talking about, by the way, we have already 2 quarters of over $1 billion of revenue, and we're not going under that ever again. So I'm very, very excited for the coming earnings. But yeah, so SoFi looks expensive only because profits are just starting to ramp. Once those margins scale, the math changes fast. And if I've not said it before, the PE stands at 113 at this point. And yeah, the transformation story goes as follows. SoFi's advantage is cost of capital. It funds loans from its own deposits instead of expensive third-party credit lines. That boosts its net interest rates. margin and makes lending profitable. Meanwhile, Galileo and Technisys act like the AWS of Fintech, stable, recurring, and high margin revenue as those platforms expand. SoFi becomes less cyclical and more scalable. So we also have AI as accelerator, because as every company, you should have AI as an accelerator or a tool. AI is a massive efficiency boost for SoFi, automated underwriting, faster approvals, fewer defaults, AI risks modeling, which means better credit quality, the AI chat and personal finance, which is a very big one, which has deeper engagement, higher IRRPU, and of course the Galileo AI-powered analytics, which gives more B2B transactions and fraud reduction. So we do have the 2030 earnings scenarios, which brings, well, the fair price, in my opinion, in a bear, base, and bull case by 2030. So in the bear case, I've literally done the worstest thing that SoFi can do over the coming years. So yeah, it's based on the PE and the EPS. And well, it brings also the CAGR. So going to a little document, just something where I could copy it. This is my bear case. So that brings the stock still 63% up from this point, but it's in 5 years. So if we calculate that a little fast, we have like 63 divided by 5 years, which brings you with a 12.6% upside each year. That's not bad, of course, because you know that S&P brings around 10 or 9% or even 8% on the base, and this would still be a nice beat, of course. And yeah, of course, I do not believe in the bear. I'd rather go with, of course, the base, but the bull is also very much possible, in my opinion, purely based on the EPS. In our base case, SoFi earns $3 per share. Also, realistic given the trajectory of deposits, platform revenue, and operating leverage. Even after compression from 113 PE to 35, the stock triples. So that brings it with 280%. If we calculate that and divide it by 5 years, we have 280% divided by 5 years. Oh, I did something wrong. 280 divided by 5. That brings you with a 56% on one position each year. But of course, we look at the whole thing and we take the 280%, which is very, very strong. So you can say that I expect stock in a base case to move to $100 or more by 2030 and not this year or next year. Of course, it can happen. I've still said it in the beginning of the video. It can happen when the right circumstances are there, and when a lot of hype is there, maybe with an S&P collision, and a lot of big funds get into SoFi because they have to. But yeah, still, this is very possible by 2030. So if you not get it next year or the year after, normally you can be certain that if SoFi keeps improving, keeps doing what they are doing now, and just stay consistent on the quality that they provide, then this is literally the price you will have in 2030. So with the bull case, that's also actually, in my opinion, not that much of a bull case. I must say that this is something more between the base and the bull. But yeah, to give this as a bull perspective, we have $4.2 of EPS in 2030, and we have a PE of 40 times. That brings the stock to a 510% upside from today's prices. And of course, the price we all want to know, $168, which is a very, very nice upside and a very nice return over 5 years only. So I'm always saying that you can put your money in the bank and it does nothing, and it actually devaluates you in worth, or you can put it in the S&P and you make some money, or you can put it in such a stable company like SoFi and you make 510% in 5 years, if the bull pans out, of course. So 510 divided by 5 years brings you with 100% each freaking year. So yeah, a lot of potential, and I still believe that this is not even bullish enough and is either more between the base and the bull. So Having talked about that, I do want to mention that the following thing we'll talk about is why the base case makes sense. Well, deposits expected to exceed $40 billion, cheap funding, platform businesses could exceed 25% of total revenue, operating margins climb toward 30%, cross-sell ratio increases, our users stay inside the SoFi app, and AI optimization cuts costs and defaults. Of course, you have to know that the older people who are at JP Morgan and Goldman Sachs and all of those big banks, they will stay there because they have too much money to just change bank. And also the younger generation rather has an app with all of the products on it, so you have literally everything on SoFi. And yeah, that's what the younger generation will be doing. So if SoFi can make a good product that brings those people into their app, and then yeah, they'll stay growing. Of course, in 3 years the rate of member growth will be way slower than it is today, because there's already so many people in the app, and there's only that X people. So the competition and moat is that yes, competition exists like Chase, Apple Card, and other neobanks, but no one combines banking, lending, investing, and tech infrastructure like SoFi does. Once a customer uses multiple SoFi products, the switching cost skyrockets. That's the mode traditional banks can easily replicate. And also, the SoFi CEO Anthony Noto said that they will probably go to 50 million members eventually, and they want each member to use 2 products on the SoFi platform. Of course, the risks to watch are economic slowdown or credit defaults could dent short-term EPS. Regulation could tighten lending or capital ratios. Valuation compression if growth cools. Fintech sentiment can be volatile, but SoFi's diversified model, lending plus tech platform, gives it more resilience than pure neobanks. The big picture takeaway is that SoFi's 113 PE isn't a red flag, it's a signal that we're early in the profit curve. By 2030, EPS at $3 with a normal 35 multiple implies about $105 per share, which is my base case normal projection for SoFi. Roughly a 3x from today's levels, and if AI can scale and push it beyond that, you're looking at $150 plus potential. So is SoFi a bubble or future banking powerhouse? Drop your thoughts below, and don't forget to subscribe if you want more deep dives like this one every week. So thanks for watching, and I'll see you guys later.